Welcome back to the Discount Property Investor Podcast. Our mission is to share what we have learned from our experience and the experience of others to help you make more money investing like a pro. We want to teach you how to create wealth by investing in real estate the Discount Property Investor way. To jumpstart your real estate investing career, visit freewholesalecourse.com, the most complete free course on wholesaling real estate ever. Thanks for tuning in. How to Brrrr.
How to Brrrr.
Let's talk about Brrrr, baby.
We're talking about how to Brrrr.
Brrrr. All right, so normally we're talking about wholesale. We'd like to talk about Brrrr as well because it's something that we've done pretty successfully. We've acquired around 100 properties in about 2 years together. And again, we're pretty proud of that. We wrote a book about that called The Brrrr Method, the ability to basically create a rental portfolio with nothing out of pocket. So we are pretty excited about that, pretty passionate about that strategy. And we've gotten a few questions about it from readers of the book and from people who have seen us talking about it in the past on podcasts. So we wanted to talk about that again today. So what is Brrrr? Real quick. Brrrr is an acronym for buy, rehab, rent, refinance, and repeat. And when we buy our properties initially, we typically use a private lender. So we're going to use someone else's money to buy it up front. And this is advantageous for us twofold. One, we're not using our own money. So again, that's an advantage. Two, when we go back to refinance it at the very end of this process, we're getting a rate and term refi, or it's just looked at differently than a cash out refi because it's not just all of our money in the deal. Mm-hmm. So we're refinancing it. We are not really cashing out our equity in the property. So again, it's it's advantageous for us to do that. So that's our suggestion is you probably want to do that. Either you can use hard money lenders. You have to have almost no relationship with them ahead of time. And they're going to be able to loan you money based on the asset, the hard asset, which is real estate, as opposed to looking at your credit. So one of the more specific questions, Dave, that we got was, how do you do this if you don't have the greatest credit? Well, it is tough.
It's very challenging.
It is tougher. And there are a couple things you can do. So we always recommend, we actually, in the book, if you check out our book, it's we make a joke that it should be Brrrr, like PBR or whatever, the beer, Pabst Blue Ribbon, Brrrr. Mm-hmm. So it should be pre-qualify. So that P should come first for pre-qualify.
Yeah, that's
before
exactly right.
you buy. And the reason is because it is so important that you're able to get that refinance, that long-term loan in place at the end of the day, that if you embark down this road and you can't, then your only option would be to sell that deal. And quite frankly, most of the people who want to be rental investors don't want to do that. Now, you could make a nice 15, 20K profit if you do everything right, which would be great. Then you're a flipper. But again, that's not going to get you closer to that passive income, that rental portfolio that you're trying to build. Mm-hmm. So what do you do? We are very...
So to get in the game, let's say
Go
this
ahead.
though. To get in the game right away, one option would be to take on a partner. Somebody that is bankable, right?
I love it.
I mean, that would be the first thing I would suggest if you can't get a loan. Because in order to do the Brrrr, you have to buy, typically, that could be a number of ways: private money, hard money, your own money, a bank loan if you're able to get it. Then you have to rehab it, you have to rent it out, but then you have to be able to refi. And that's really where Mike's saying, get pre-qualified, because if you go out and you aren't pre-qualified and you get approved by a hard money lender, which is typically way easier to get approved by than a bank because they have a higher rate and a shorter term. Mm-hmm. And then you get it rehabbed and rented. And if you can't qualify for that refi, well, then you're stuck paying a super high interest rate on a short-term loan to a hard money lender that may be okay with you paying that rate for a long period of time. But typically they're going to want to take that property back and sell it to liquidate their own risk, right? So you want to get that pre-qualification done in the beginning. Now, if you get pre-qualified and you get denied, well, you can still proceed. Just have to take on a partner that can be qualified And then you would have to put in the legwork or provide some sort of value to that person to get them to partner with you. That'd be the easiest solution to get in the game and do this. But again, you're going to be giving up something by taking that partner on. The other option will be to figure out what you need to get qualified and work on those things. Isn't that where you were going to probably go, Mike?
That's exactly where I was headed. So
Okay.
it is. It's basically a game, real estate. You're always looking for good deals, and you're always looking for more money. As a wholesaler,
Right.
as a rental buyer, you're always doing those two things. And the looking for more money means I'm looking for more bank money at this point. I want someone who's going to loan me money long term at a low rate.
Mm-hmm.
So if you can't get qualified, work on your credit, figure out what you can do to improve your credit, because it is so important. This isn't the stuff they teach you in school. I don't know why they don't. This is more important than most things you're going to do, is keep your credit score up. This goes over to Travis. Travis, one of our acquisitions guys.
Mm-hmm.
Great guy. He's like, man, I really want to start doing Brrrr too. And he was telling us
Last week.
he told us he read the book and is very interested in it, and said, well, I just don't have any assets. It doesn't really matter, man. If your credit's okay, if you go do the Brrrr method, there is an asset that the bank gets to loan against. They like that. Banks like having an asset to loan against.
Mm-hmm.
Like, that's easier for them to do than to set up a line of credit. So that's what he was asking me about. I was like, should I go get a line of credit or something?
Yeah, unless you have
No.
stocks or bonds or real
Yeah.
estate to pledge, you're not going to
You
get a
don't
line
need-
of credit
you don't
too.
need a line
or
of
you may get
credit.
like a credit card line of credit. You know, like we have some students
50,
that
100 grand or so tops.
150
Yeah.
grand, 200 grand,
Yeah.
something like that. Typically 0% credit cards through Fund and Grow.
Oh, that's right.
We love them. However, it's temporary. That's 18 months
Yeah, that's
of
short-term.
0% interest, and then that rate's going to go up to 15 or 20% or higher, depending on how you do it. Now, if you are responsible, hey, that's 18 months, 0%. You're going to pay a couple grand to get enrolled in that as well, though, and have somebody help you set that up. But typically, yeah, you are absolutely right. You know, that's one of the best ways to acquire assets if you don't have any already.
Well-
But going to the bank and starting the relationship was where we pointed Travis. That's the first thing we both said is,
Well, to your point about the Fund and Grow, using that, to me, that would be a great way to acquire. So that'd be a great way to buy it day one
and rehab. Yep.
and rehab.
Or
But it probably is not a great idea to have them as
your long-term
Yeah,
mortgage
that's-
holder, which really wouldn't be a mortgage. It'd just be a credit card debt to compensate, or in exchange for it. But yeah, you're talking a rate
Yeah, it could go up to 30%.
10 times the rate of what a bank would offer you. You know, 4 to 5% versus 40%.
Yeah, but again, it's a great way, like you said. So
To purchase, though, yeah.
to purchase or to fund a rehab, because if a hard money lender, oftentimes they're only going to lend a certain percentage of the deal. So maybe you can get them to fund the purchase, but not the rehab as well.
That's a great point.
So you couple those two things. You use a hard money lender to buy it. You check out our dpipodcast.com toolkit and find Fund and Grow on there, our funding partner, and they will lend you the money, or they'll help you qualify to get the money, 0% interest, to do your rehabs.
Mhm.
So that'd be another good way to get started on that. Dave said, yes, find a partner. That is probably our best bet for someone with poor credit to get started as soon as possible, because you've got to
Fixing credit may not be quick. That's
It's
you
not.
know?
It's not a quick thing.
I mean, you may be able to jump it up 15, 20 points relatively quick within, and I mean that like within 2 to 3 months. Like that's quick in credit world, right? You know, so but getting a credit score to be fixed from 500s to get up closer to the 650, 700 range, that's going to take some time, and typically that's going to be paying off debts or spreading your debt around. You want to keep your
Let's real quickly talk about some things you can do to keep your credit score high, because this is stuff that I didn't know when I started. So I was, I think, 17 or 18 or so when I applied for my first credit card, because I knew I wanted to build my credit history. So I've always gotten loans on things. I've gotten loans on cars, again, for myself because, well, one, I didn't have the money, and two, because I knew I wanted to build my credit.
Yeah.
So I had revolving credit. Those are what credit cards are called, is a revolving account. And I had those since I was 18. I got different ones, from time to time. I got a one with this bank, and then I changed banks, and I got another one. What I didn't realize, Dave, is that the length of time that the account is open also affects your credit history. and your score. So I closed down some of my older ones. Now, this has been years ago. I've had the same accounts now for many years. And, well, we don't need to go into all the details. But if you have an old credit card, the reason I'm getting at this, guys, if you have a really, really old account, don't just go cancel all your old accounts to try to improve your credit score. That's not going to help. Keep your older accounts. Cancel the Kohl's card if you just opened a Kohl's account, because it's silly to have that much, on a whole bunch of different little accounts. So yeah, again, a length of time that accounts are open is very important, as well as payment history. So again, make sure you know that. Any other little tips you have on credit
keep
score?
the balance below 30% or 35%. I've heard different numbers, but if you have a $10,000 credit card
Credit limit.
and ideally, not everybody is able to do this, of course, but this is just how they work. If you're able to keep the amount borrowed against that $10,000 below, I think it's 30%. It's going to help with your credit reporting and your scores.
So why is that? Because
Well,
if you have a 50 or 60% of used credit to available credit, you're higher risk, right?
You're higher risk, right?
So it's just it's keeping that down to 30% or less means that you're lower risk. Therefore,
try not to miss a payment or be late on it.
Yeah, do not miss payments.
Yeah, I mean, if being late's one thing, but don't miss them altogether completely. Make them.
So set up auto payment, guys.
Yeah.
Super easy way to make sure you make your payments. Set up auto payment on your cards.
That's right. And then a couple other things that I could think about would be
And don't spend money if you can't pay it back.
yeah.
I know that sounds silly, but I mean, if you have no way of doing it, try not to do it, guys.
So
Like, you're
credit's
just digging a
really
hole.
usually only about half of the thing. The other half is debt to income.
Mm-hmm.
They want to know how much. So when you go to apply for a loan at a bank, for a refi or a purchase or whatever it is, in order to, part of the underwriting process is how much or how good is that person's credit, and that's going to affect the rate ultimately as well, if they have a good credit or bad credit. Not a whole lot, but it definitely is affected by the rate. And then secondly would be the debt to income, which is just a simple ratio, guys. It's how much debt do you have and how much income do you have, and I think it's debt over income or income over debt. I'm not really sure how to calculate that, but
and this is something that we harp on too, because a lot of guys like us, like myself, who didn't do it right, you get into real estate, you start making big paychecks, more than you made before. It's really exciting, and you want to quit that day job. We really, really don't like to see that, and this is something that goes back to the question that was asked of us about how to improve your credit or how to get into Brrrr right away, is keep your day job. Keep your W-2 income until you've got 1 to 2 years of tax returns showing that you're making money on your own as a self-employed individual.
As a part-time.
Doesn't really matter. Yeah. So no matter where you're at, you want to keep your current job, because a history of the same W-2 job makes you more bankable.
Mm-hmm.
So keep that W-2 job. It's going to be easier to get a loan.
That's right. At least for the first 2 years.
Several years. I mean, again, until your tax returns show that you're making money on your own, meaning you're paying the government taxes on that earned income, until you do that, you're not necessarily going to be able to get a bank to want to loan you money.
That's a great point.
So again, it's a catch-22. Show the government how much money you made and file it all, and then you're going to pay a lot of taxes. Or don't show the government everything you made, or take all the deductions you can get and pay very little in taxes, but then you're not going to be able to get loans.
So you're not going to be able to get loans. Yeah. That is.
Yeah, it's difficult.
That is one of the biggest challenges that we face, that Mike and I, face is, do we try to take every single deduction and depreciation and this and that and to try to reduce our taxes? And in theory, that sounds like a great idea. But if you can reduce your taxes down to basically zero, the problem with that is you're not making any income that's taxable. And that's what the bank wants to see. They want to see taxable income.
Now, banks can look past it. I mean, they can see if they look into your financials, and they can see it. But it's just, they want to see W-2 income.
They want to see paid taxes on income. Yeah. That's really what they want to see. So that can be challenging sometimes. So sometimes we have to say, all right, well, let's not take every single deduction and
hide
tax break
Yeah.
that we can
Yeah.
because we have to be paying some taxes so we can show that we have income so we can keep getting loans. So that will definitely be a balancing act. And that's a little bit more 2.0. I think that's a little bit more down the line. But in the beginning, if you want to get involved with Brrrr,
It's not though, Dave.
go get pre-qualified.
It's day one stuff. Because a lot of people try to hide income. They don't want to pay taxes. Don't do that.
Yeah,
Even if you're a
just be aware of
self-employed
it.
lawnmower or I'm thinking of some of our contractors who don't want to pay taxes and they don't want the 1099.
Yeah, but they're also not able to get loans.
You can't get a loan. Pay your taxes, guys. Like, it sucks.
Yeah.
Pay your taxes. Pay an accountant $1,000 for the year to help you not pay as much, but
Yeah.
show that you made the money.
Show that you made some money, right?
Yeah, it's just crazy.
So number one, though, get out there, and if you can't get approved for yourself, then maybe take a partner on that can. That's an option one, or get a co-signer. That may be another option other than a partner. If you don't want to share equity, get a co-signer. That may be a little bit more difficult, but it is an option. I had co-signers on my first couple loans that I had when I was in college, and I worked at like pizza places or sandwich shops. So I had income, but it wasn't much at all. So I had to have co-signers. So partner or co-signer would be option one to get you started right away. Option two would be go try to get pre-qualified, talk to your banks, figure out what the issue is if you aren't approved. And don't get upset if you aren't approved. Mike and I have done this 100 times, and we still get denied whenever we reach out to certain banks because they may not have the appetite for these type of loans right now.
It's complex underwriting.
It's complex underwriting,
Yeah.
and it goes up and down. They may have an appetite, they may not. So certain times a year, they may want to work with us. Certain times they won't. It also depends on the economy. So if a bank tells you no, find out why and try to work on those things. But in the meantime, go start talking to other banks. So Mike and I work with 6, 7, probably, I would say probably 8, closer to 8 or 9 banks if you include.
We've got relationships with probably 8 or so.
8 or 9,
different lenders.
different lenders. And we're constantly bouncing between, them because we want to get the best deal we can get at the lowest rate as well. But sometimes some of these lenders will say, hey, we don't have an appetite for this right now. So it helps to have multiple lenders that you can work with, but also figure out what those requirements that each lender has are. And if you don't meet those, well, then just start working on those. And typically it's going to be 2 things. It's going to be debt to income, or it's going to be credit, or both. It could be something else, of course, but that's typically the 2 things that are going to make or break you getting involved in this game. So that's really what it comes down to, guys. If you have terrible credit and you have no plans of fixing it, this may not work for you if you can't get a partner.
Yeah. So what? So what if it takes you 2 years to repair your credit?
Right.
3 years to repair your credit.
That's a good point.
And then you build your portfolio
And then you can
after
start
that.
buying assets later. Yeah.
Like,
And
come
that's
on.
such a
Like,
good point.
3 years in the scheme of your 80-year life? Like, yeah, there's no reason not to, guys. So get out there, figure out what is keeping you back. If it's something your credit, figure out how to fix it. And, yeah, get going.
Awesome. Signing off, guys.
Thanks for listening to the Discount Property Investor Podcast. If you enjoyed this episode, please like, share, and subscribe to help us reach a wider audience. To jumpstart your real estate investing career, please visit freewholesalecourse.com, the most complete free course on wholesaling real estate ever. We would also appreciate it if you left us a review on iTunes or Stitcher. Thank you in advance for your support, and remember, you make your money when you buy, and you get paid when you sell. Now let's go build some wealth.